Today I want to talk to you about dividend investing. That's a topic I used to be extremely excited about and consider myself a dividend investor in the past. So that's why today I want to kind of answer the question whether dividend investing still has a place in 2025 and going forward, because it's always interesting. When I used to be a dividend investor, a lot of people came into the comments say, "Guy, dividends are useless. There's no point investing into dividend paying companies." But now that I shifted my approach away from dividend investing, interestingly enough, now I seem to have more people telling me that dividends is actually the way forward. And that's why I really think it's interesting to look at both of the scenarios, see which one is better, and more importantly, which one works for you. Because very often I see people getting so defensive about their investment strategies. It's almost like when it comes to football, right? If you like this club, you cannot like this club, and vice versa. My club is the best, and they apply the same logic to investing. And I think it's the wrong approach, because first of all, there's no perfect investment, right? If there was, guess what? Everybody would be investing into that. But there's so many different ways how you can invest your money. And I think that's the beauty of investing. And second of all, there's no right or wrong. It has to work for you. So don't ever let anyone tell you what you should be doing with your money, especially people on the internet or here on YouTube. We can share our thoughts and opinions on our own strategies, but ultimately it's your money and your investment decisions. So let's look at the performance of dividend paying companies versus non-paying dividend companies. And obviously I compared to the S&P 500, the golden benchmark when it comes to market returns. And that's probably where I invest most of my money these days into. And in the end of the video, I'm going to share with you my point of view, whether dividend investing should really have a place in your investment strategy or whether it's actually an outdated way to invest. And there might be better ways where you can allocate your money towards. But very quick reminder, I'm sure if you're watching this video, you're pretty familiar with the concept of a dividend. Basically, since you become a shareholder in a company, they pay out parts of their profit to all those shareholders, including you if you are in that company, and you get a part of the profit, right? Depending on how many shares you get, proportionately, you get more dividends. So that's the underlying principle and concept of it. However, not every company actually decides to pay out a dividend. A lot of companies, especially tech companies and innovative companies, instead of paying out a dividend that acts as profit, basically, they decide to reinvest it into the company, into research and development, to grow the revenue in the future and therefore have hopefully even more profits in the future. That's a different kind of thinking. And that's obviously where the fundamental difference of dividend investing versus total returns investing comes into place. And the term total returns for me is very important. And we'll come to this later on because I think that's a very important concept. And you may wonder, why should I be investing in dividends in the first place, right? And obviously there are a number of reasons, and I made some videos about this in the past, but one of the very appealing points is of course the dividend yield that's paid to you. If we jump over here to Seeking Alpha, which is my favorite stock research tool of choice, you can see over here one of the dividend darlings, I would say. A lot of dividend investors, when they start investing, myself included at the time, is Realty Income, ticker symbol O. Very, very popular because they actually pay a monthly dividend. So every single month you're going to get paid by them, which is really cool feeling, right? It's almost like a salary, but here you get a dividend because you are a shareholder in the company. And look at this, the dividend yield right now, they're paying 6%. Obviously, it's on an annual basis, but that's very attractive, right? It's way much more than you would get in interest if you leave your money at a bank account. Plus, of course, hopefully over time, we'll look into this in a second, the stock price will also appreciate long-term, right? So that's one of the big reasons why it's appealing for many. Because let's be honest, right? If you invest into a boring ETF that doesn't pay you a dividend, well, hopefully over time, your portfolio grows. But ultimately, how do you actually live from it, right? Because a lot of people want financial freedom where the investments pay for their living expenses. That's amazing, right? We all eventually want to get there, myself included. But if you don't get a dividend, you're not really getting paid, on the paper value or in your portfolio. When you open it up, the number grows. That's great. But ultimately, if you want to live from it, it would mean you have to sell some of it to then use those proceeds to pay for your everyday living. And that can be a little bit challenging, right? When to sell, it feels uncomfortable to sell, just psychologically and so on. So instead, getting paid a dividend is quite appealing to many. And myself, as I said, included, I used to really be into that, invest every single month to grow my portfolio. And it's also one of the beautiful things to see your annual income from dividends grow. With every stock you buy, you see immediately the increase of future income being paid to you. And that's quite addictive, right? It's really nice and motivating also, especially for people who are looking to invest for a retirement. I think it can be really appealing because you kind of have a predictable cash flow income, right? Once you have a certain portfolio size, just imagine one day, hopefully you hit a portfolio size of $1 million, pounds, euros, whatever is your native currency. And imagine you have average dividend yield in your portfolio of 10%. Now, obviously 10% is very much on the high side. It usually isn't 10%. That will be very, very high and sometimes something to look out for. I'll speak about this also in a second. Obviously, usually it would be less, but just for the sake of the exercise, imagine it's 10%. That would mean an annual dividend income of 100,000 euros, dollars, pounds, whatever it is. that's very nice to live off, right? For most people, right? Depending on where you live in Dubai, it may not get you that far, but in many other cities and countries around the world, it obviously is a very nice passive income without having to work, and maybe more reliable than only relying on your government to pay you a pension. So I get the appeal of dividend investing. However, the biggest problem I see with dividend investing is with regards to total returns. And total returns is a very, very important concept, because while it's nice to receive a dividend, as we saw over here in the case of realty income, you get 6%, amazing, very, very cool. However, I mentioned before, dividend is just one component of your investment. The second component is the stock appreciation, hopefully over a longer period, right? Same way how you would buy a house or apartment as an investment, you would rent it out. You would get the rent on a monthly basis, right? And hopefully the capital appreciation of that house or apartment hopefully going up over time. Now, if you only get the rent paid to you, but you bought the house and apartment in a bad area and actually loses in value, or something goes down, the neighborhood goes under, whatever happens, and the house halves in value, well, even you're getting the rent income, it actually may not offset the loss of the value of the house or apartment. So the same principle is to be applied here when we invest into stocks, I believe. And that's why I really want to look at total returns. And you can do this very easily here on Seeking Alpha. If you click on momentum over here, as I said, for me, I always compare everything to the S&P 500, the golden benchmark. That's just when we talk about market returns, which it has been around 10% on average over the last 30 years. That's what I want to compare any investment to, right? Anything doing better than the S&P 500, amazing, great investment class over a long time I'm talking about. If it underperforms, well, that's then food for thought, because ultimately I could just invest into S&P instead. So that's why I want to look at that. Now here we have a couple of different metrics. We can compare the price return. So that's why I said how the stock price without dividends basically did versus the S&P 500. And if, for example, I look here, again, I'm on realty income. Over a 1 year period, it's down 11%, while the S&P last year was, of course, a very, very strong year because of tech stocks doing extremely well, up 24%, which is also not normal, right? We've also had years where the S&P dropped year on year, right? If I zoom out even further, 5 years, still the value of your investment actually dropped in realty income, as you can see over here, which is really, really painful to see, while the S&P is up 81%. If I go out even further to 10 years, realty income, if you bought it 10 years ago, you're pretty much exactly at the same point where you were 10 years ago, which is crazy, right? While the S&P is up almost 192%. So really, really nice. But that's just only the price. But as we know, realty income, in this case, pays a very juicy dividend of 6%. At some stage, it was even 7%, right? It fluctuates, it's not only fixed. But the S&P pays a much lower dividend because that's all the 500 companies in there. That's around 1.1, 1.2% on average. So if I go down here, you will see total return. So now we should see a much different picture, because obviously realty income is boosting with the dividend incomes the total return. The two parts is price appreciation and the dividend component. Those two together is the total return. That's very, very important to look at. Well, to my surprise, and maybe some of yours as well, it's still down on a 1 year period. Realty income minus 6%, even with that dividend factored in. On purely price, it dropped by 11.72%. But then because of the 6%, 5%, or whatever it is, it actually is only down to 6% because the difference is the dividend that we received. But still, it was not able to offset the loss in share price. If I zoom out even further to 5 years, it's still down despite the high dividend, minus 7% versus 96%. And if I go to 10 years, you can see even for the S&P 500, which has a very small dividend, but on top of it, as if I compare it to the 10 years here, 10 years it was only 192%. Now it jumps to 254%. So even that small dividend over time does add up. And finally, it's good to see realty income being in the plus. Again, from a 10-year period of slight degrowth actually, or at least flatlining, at least with the dividend alone, it pulls up to 62%. But over a 10-year period, 62%, me as an investor, I'll be quite upset with such returns. Now I get it. You might be thinking to yourself, well, Kai, you cherry picking some individual dividend paying companies that underperformed. Look at some other ones. And obviously there's a lot of dividend companies to go through. In fact, as per ChatGPT, it's exactly 406 companies out of the 503 companies inside the S&P 500 that have been paying a dividend. So a clear majority of companies is paying a dividend. But of course, we also should define what really is a dividend, right? Because when we look at the biggest companies in the US, of course, right now we have again on the top spot Apple. So if I jump into Apple, you can see they're also paying a dividend, but it's tiny, 0.41%. So imagine you had a 1 million portfolio in Apple, right? At 0.41% dividend, that would equate to 4,100 euros, dollars, whatever, you denominate your portfolio in. But obviously that's not enough to live off, right? Now, obviously Apple has been growing the dividends over time. So if you zoom out over here, the dividends, you can see for the last 11 years, they have been growing. They have a stable dividend growth rate as well. So they have obviously hiked up the dividends. So if you got in early, maybe it will be slightly more, but still to live off that, you would need to have a huge portfolio to actually make any difference to your living standard. And another very important point to keep in mind when we talk about dividend investing, as nice as it is to get the dividend, there is no law or rule that prohibits the company from stopping to pay dividends, right? If they're going through a difficult phase, maybe a couple of years in a row, which we have seen in 2020, 21, 22, when businesses were closed, they're going through difficult times, they're not making a profit. Well, guess what? They're not taking a loan to pay out investors. They would rather stop their dividends for a while and not distribute any profits because, if there aren't any, there's nothing to distribute. And then you, as an investor, who really relied on the dividend might actually struggle. So that's also something to keep in mind. It's not set in stone that the company, if they start paying a dividend, has to pay a dividend forever. It's just while things are going well. If they won't go so well anymore, well, you're going to have an issue. They're going to stop those payments. And if I jump back into the top 10 of the S&P 500, we see here all those companies. And what do you see? At least the top 8 are all tech-heavy companies, right? All of them, Apple, Nvidia, Microsoft, Apple, Amazon, they're really investing into AI, into technology, and all these innovative technologies coming up. And guess what? They use those profits that they generate, and they're big profits, to reinvest and stay ahead of the curve, right? If they don't reinvest, they will fall off and fall behind. And that's exactly what happened to some of the companies who didn't innovate. They paid a nice dividend, but didn't innovate, right? Here we are inside the top 20 S&P 500 companies by year, and I'm actually here on 1990. So in the 1990s, you had the most valuable company in the world, or at least in the US, ExxonMobil, number 2 IBM, then Walmart, and then for example here, Coca-Cola used to be in the top 10 most valuable companies in US. I mean, unbelievable, right? Right now, nobody would think that. They're actually still doing not too bad, but they are a boring company. Now, they have a great business model, they're making money, no question. But obviously, if you really believe that Coca-Cola is going to be the future rather than tech, AI, robotics, what have you, well, that's up for debate. Nobody knows the future, but I would rather bet my money on technology companies than some boring consumer staples, right? And that's what you see over here. Back in the days, most of those companies are actually really good dividend-paying companies like Johnson & Johnson, Pepsi, Coca-Cola, Procter & Gamble. So these are real dividend darlings of dividend investors. But when you look at where they are today, well, not really represented in the top over here. You do have a couple of ones like Visa, but even Visa has a dividend yield of 0.75%. Once again, you would need to have a huge portfolio to make any tangible difference to your income that you get in the form of dividends. And when I did this exercise for my own dividend investments that I had, and I think at the most I had around 15 dividend paying companies, and I went through this exercise myself, looking up the total returns versus the S&P 500, and guess what? I did not have one single company that outperformed the S&P 500. And that's when I realized I'm really not maximizing my money. Sure, it's nice to see that dividend being paid to you and growing over time, but ultimately, if my total returns, my portfolio does not grow as fast as it could if I invested into the S&P 500, well then why am I doing it in the first place, right? Plus the additional risk that those companies might potentially stop paying their dividends, and I'm not really future-proofing myself because most of those companies were really legacy companies, kind of old school companies like Coca-Cola or Altria, a smoking company, right? Really not the future if you ask me, right? And another point, actually, I don't have to worry about which sector or industry is going to be the winning one. Well, I could probably see that tech is going to be thriving for the coming years. But even if it didn't, by investing into the S&P 500, I'm diversified. So whichever industry is thriving, I would be benefiting as an investor. Versus if you're a dividend investor and pick individual companies, you're making an industry bet. You're betting that this company will do well over the next 20, 30, 40 years. As you would be as a long-term investor. And I think that's just very risky, right? The same how I don't pick individual company shares because, yeah, it's more risky. Maybe they will do well, maybe won't. And we've seen before that companies over time, they come and go, right? There's not one company that has been the number one company for the last 30 years. There's just no company. It's very dynamic. They keep on moving. And that's when I realized for me, investing into an ETF works much better. Here we are inside my eToro portfolio. You can see I have 2 ETFs. S&P 500 ETF as well as the Nasdaq 100 ETF because here I'm really doubling down on the tech, and the beauty is irrespective of which company is going to win. Is Nvidia going to be the winning horse and take over Apple and continue to grow to maybe 10 trillion one day, or is it one of those less valuable companies over here that will start ramping up and increasing market share and value and take the top spot? I don't know, right? But that's why I invest in the ETF, because I know my total performance will be market returns, which I believe and experienced is very, very difficult to beat and outperform with individual investments, especially into dividend paying companies, because let's be honest, they're usually less innovative. That's why they started paying out dividends, because otherwise people may not want to invest in it in the first place, right? Because generally quite boring companies. So if they were to stop paying dividend, who would really invest in Coca-Cola? It's a kind of boring, predictable business model. If you don't get any dividend as an investor, there's no incentive. Then everybody would rush to invest only in tech companies. So that's just also something to keep in mind. Plus a concept called dividend trap. I alluded to the fact earlier that some companies are paying dividends of 10%, even higher. That's what is called dividend trap, because you as an investor might think, wow, I'm getting 10% return on my investment, but they do it for a reason, because actually the company may have real fundamental flaws to their business model. The revenues are declining, profits are declining. So the only way how they can keep their investors and attract potentially new one is by paying a juicy dividend. And sometimes they even take a loan just to pay that. So obviously that's a lose-lose scenario and not sustainable for the long term. So you have to be very mindful. For me personally, anything over 6%, you have to really think twice whether you really want to invest into that company or not. Of course, there are also many other factors to consider, such as taxation. Some countries actually have very favorable dividend taxation rules, while others, they tax them extremely high. So you want to have as little dividends as possible and rather automatically either reinvest or have the gains through share appreciation in the long term. So that's also something to consider. But again, it's a bit hard to comment depending on where you live. You should double check. But yeah, as I said, if you have less favorable taxation rules in your country of where you buy your dividends, then that's yet another reason of not investing into dividend paying stocks only. Now, obviously by now you probably figured out my thoughts around dividend investing. So why I personally moved on from it, I did it in the past, but realized I cannot beat the market returns. I really shifted away from it and follow what I call my 3-pillar investing strategy. That's real estate, ETFs, as I just shown you, S&P 500 and Nasdaq 100, and lastly, Bitcoin. I'm a Bitcoin maximalist. I do believe in the coming years we're going to see some nice price appreciation, but that's just what works for me. It's generally quite conservative with a bit of risk in the form of Bitcoin, but it works for me. At the same time, guys, I'm really not saying dividend investing is a bad thing, right? Because a lot of people, they see investing or anything in life black and white, right? It's either good or bad. And I think there is a place for purple or gray, whatever color you like. There's something in between. And while I don't like it personally, I still recommend for some people, it may be a good way to at least have some exposure to it. It doesn't mean you have to be 100% into one investing class. And I never recommend that. That's why I also have a 3-pillar approach, right? So you want to maybe diversify across the same way how some people invest in gold. I don't like gold. For me, it's really boring. It doesn't pay me a passive income. To store it is very cumbersome. To move it around, not ideal. But I know so many people in the world love gold. And that's amazing. If it works for you, great. As I said at the beginning of the video, don't ever let anyone tell you what's the best way to invest. There is no best way. It has to work for you. But just be honest to yourself when you compare your own dividend investing portfolio versus the market, in this case S&P 500, are you fine that you're potentially underperforming? Because personally, if you're overperforming with all your dividend shares, let me know. I'll be happy to learn from you. But most likely you're underperforming. And that's fine, right? Because you really bank on a passive income over time, which means maybe you have 40% of your portfolio in dividend shares and the rest in S&P 500 or Nasdaq 100 or real estate or Bitcoin, whatever it might be. I think that's a smart way to go about it, to diversify. Maybe have some exposure to it. So I'm really not saying that dividend investing is inherently bad. Absolutely not. I think it can really have a place in an investor's portfolio. And if you are interested in the topic of dividends, I can really recommend you the YouTube channel of Ryan Williams. Amazing guy. Really, if it comes to dividends, he is the guy I go to watch his videos. He was probably the one who got me excited to invest in dividends in the first place. So really shout out to Ryan. Definitely follow him along. Really interesting stuff that he puts out. But I'm also very interested to hear from you. What's your preferred way of investing? Is it dividends, ETFs, cryptocurrency? Let me know in the comments down below. Happy to hear from you. And if you want to learn more about my investment strategy going forward, and check out this video over here. And if you enjoyed the video, please give it a like, subscribe to the channel. It helps out a lot. And as always, stay healthy, get wealthy, and I'll see you in the next one. Ciao.